If you're waiting for the perfect time to start building wealth, I've got news for you. It's not coming. But right now, in June 2026, the top entrepreneurs in the world are doing something different than what they were doing last year. And the gap between what they know and what the average person knows is wider than ever. By the end of this video, you're going to understand exactly what separates them from everyone else. Let me start with something that might surprise you. The S&P 500 is down 1.7% this month. The Nasdaq is down 2.2%. Bitcoin has crashed 23% in the last 30 days. Gold is down nearly 14%. Most people see this, and they panic. They pull their money out. They wait on the sidelines. They hope things stabilize. But the entrepreneurs who are building real wealth right now, they're doing the exact opposite. And I'm going to show you why. Here's the secret that changes everything. The wealthy don't think in terms of markets. They think in terms of opportunity. When everyone else is scared, they're analyzing. When everyone else is frozen, they're moving. But here's what separates the good entrepreneurs from the great ones. They're not just buying dips blindly. They're being intentional about how they're positioned. Let's talk about diversification, because this is where most people get it wrong. Everyone knows they should diversify their portfolio. They throw some money in the S&P 500, maybe some bonds, and they think they're done. But the top entrepreneurs in 2026 understand something deeper. They're not just diversifying between asset classes. They're diversifying between control levels. What do I mean by that? Think about it this way. If you own index funds, you have zero control. The market moves, and you move with it. If you own individual stocks, you have slightly more control. You can pick winners and losers. But if you own a business, or a piece of commercial real estate, or a rental property, you have significant control. You can improve operations, you can raise prices, you can cut costs, you can compound growth through your own actions, not just market movements. Right now, with interest rates still elevated and market volatility spiking, the smartest entrepreneurs are repositioning. They're taking profits from volatile assets like Bitcoin, which is down 23% this month, and they're moving into controlled assets. Some are acquiring undervalued commercial real estate. Others are buying revenue-generating businesses. A lot of them are investing in their own ventures. Here's a specific example. Let's say you have $100,000 in your portfolio. The average person might split it like this: $60,000 in index funds, $20,000 in bonds, $20,000 in cash. But a top entrepreneur in 2026 might structure it like this: $30,000 in index funds for passive growth, $10,000 in crypto and commodities for volatility exposure, $20,000 in a real estate syndication or REIT for income and control, $25,000 in their own business or side hustle, and $15,000 in cash for opportunities. The difference? The second portfolio is designed for wealth creation. The first is designed for stability. Now let's talk about something that's completely changing the game in 2026: artificial intelligence. Every single top entrepreneur I'm tracking right now is using AI to automate something in their business. And I'm not talking about the hype. I'm talking about real, measurable time and money savings. Some are using AI to handle customer service. Others are using it to generate content, analyze data, manage inventory, or even write code. The beautiful thing about this moment is that the tools are accessible. You don't need to be a tech genius. ChatGPT is free. Claude is free. There are AI video generators, AI email tools, AI scheduling assistants. The entrepreneurs who are winning right now are the ones who are systematically replacing their time with AI so they can focus on the decisions only they can make. Here's why this matters for your wealth building. Time is your most limited resource when you're starting out. If you can save 10 hours a week by automating repetitive tasks, that's 10 hours you can spend on revenue-generating activities. And in most businesses, the difference between someone who makes 50 grand a year and someone who makes 200 grand a year isn't intelligence. It's where they spend their time. The top entrepreneurs are using AI to buy back their time. Let me give you a real scenario. Let's say you're running a service-based business: consulting, copywriting, design, coaching, whatever. You're spending 5 hours a week on administrative stuff, responding to emails, scheduling calls, invoicing, following up on leads. An AI assistant can handle 80% of that, You're immediately back 5 hours. At $100 an hour billable time, that's $500 a week you just created. That's $26,000 a year in new capacity. And the AI tools cost you maybe $100 a month. That's not a coincidence that top entrepreneurs are obsessed with this right now. Now, let's talk about capital efficiency and timing. This is where most entrepreneurs fail, and it's critical to understand. The market is sending a very specific signal right now. We're seeing geopolitical tension. Trump's new Iran threats are causing volatility. We're seeing potential interest rate movements on the horizon because Trump's new Fed chief may need to raise rates soon. We're seeing sector rotation, with chip stocks bouncing, but gains being limited. Most people see this chaos and feel paralyzed. The top entrepreneurs see this and ask, where is capital flowing? Where is the market inefficiency? Right now, there are several answers. One, the Visa and MasterCard swipe fee settlement of $38 billion is reshaping how payment processing works. That's creating opportunities for alternative payment solutions. Two, there's massive interest in pension-like 401k solutions. Fidelity just made a huge bet on this. That tells you people are anxious about retirement and looking for stability. Three, there's volatility in tech and crypto, which means there are discounted entry points if you have cash ready. The entrepreneurs winning right now are the ones who have dry powder. They've kept cash reserves specifically for moments like this. They're not fully deployed. They're not all in on one thesis. They're positioned to move when the opportunity shows up. It's not exciting. It's not sexy. But it's how real wealth is built in volatile markets. Here's something else the top entrepreneurs know. You need multiple revenue streams. Not because it's trendy, but because it's the only way to build sustainable wealth. Your day job might be stable, but it's dependent on one employer. Your business might be growing, but it's dependent on market conditions. Your investment portfolio might be earning returns, but it's dependent on macroeconomic conditions. If you combine them, suddenly you're not dependent on any single thing. Right now in 2026, I'm seeing successful entrepreneurs structure their income like this. Primary business income, which is their main focus. Side revenue, which could be an online course, a service offering, a product line, something that runs somewhat independently. Investment income, which includes dividends, rental income, interest, appreciation, and opportunity income, which is their dry powder being deployed when markets create opportunities. A really concrete example. Let's say you're a software developer earning $150,000 a year. You launch a SaaS product on the side that generates $500 a month. You have $100,000 invested that earns $6,000 a year in dividends. And you have $50,000 in cash waiting for a deal. Suddenly, you're not stressed about your day job because 70% of your income is coming from other sources. You can negotiate better at work, or leave if you want, because you don't desperately need that salary. That's the position the top entrepreneurs are building toward. Now, I want to talk about something psychological that separates successful entrepreneurs from struggling ones. It's how they relate to money. The average person relates to money as something to be feared or protected. They're defensive. The top entrepreneurs relate to money as something to be understood and deployed. They're offensive. This shows up in how they make decisions. When the market is down and volatility is high, the fearful person asks, how do I protect what I have? The confident person asks, where can I deploy capital for returns? When they see prices dropping, whether it's stock prices, real estate, or business valuations, the fearful person looks away. The confident person is analyzing. That's not recklessness. That's strategic opportunism. What's changed in 2026 is that information is more accessible than ever. You can see exactly what market movements are happening in real time. You can understand why Bitcoin is down 23% this month. You can read about the geopolitical risks that are driving volatility. You can model out different economic scenarios. The entrepreneurs who are moving faster than others aren't smarter. They're just less distracted by fear. So here's what I want you to do this week. First, do an honest assessment of how your money is currently structured. Not how it should be structured in theory, how it actually is structured right now. How much is in stocks? How much is in cash? How much is in business? How much is idle? Write that down. Second, identify one area where you're spending time that could be automated with AI. It doesn't have to be major. If it's handling customer emails, set up an AI tool to draft responses. If it's content creation, use an AI generator to create first drafts. If it's scheduling, use an AI scheduling assistant. Pick one thing and implement it this week. Measure how much time you save. Third, look at your revenue streams. Be honest about how many you have. If it's just one, identify what a second revenue stream could be. It doesn't have to be massive. Even an extra $500 a month from a side project changes your financial picture significantly over time. Start brainstorming what it could be. Fourth, keep some dry powder. If your money is 100% deployed, you're not positioned for opportunity. Start moving toward having 3 to 6 months of expenses in accessible cash. I know that's boring advice, but boring advice is what wealth is built on. The truth is, the entrepreneurs winning right now in 2026 aren't fundamentally different from you. They just made slightly different decisions earlier and then compounded those differences over time. They diversified across control levels instead of just asset classes. They deployed AI to buy back their time instead of grinding harder. They kept dry powder ready instead of deploying everything. They built multiple revenue streams instead of relying on one. And crucially, they approach volatility as opportunity instead of threat. You can start doing those things this week. And if you do consistently for the next 6 months, a year, 5 years, you're going to be in a completely different financial position. That's what separates the top entrepreneurs from everyone else. It's not luck. It's not a secret. It's just slightly better decisions, made repeatedly over time. If this video added value, subscribe to the channel because we're breaking down exactly what's working in wealth building right now, not what worked 5 years ago. Drop a comment and let me know. Which of these strategies are you going to implement first? The AI automation, the portfolio diversification, the multiple revenue streams, or the dry powder position? Let me know what you're going to try. Thanks for watching, and I'll see you in the next one.